Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. We have a lot to talk about today. Gosh, we got to talk about those inflation numbers, the strong dollar. Chase, so many things to talk about.
Oh, yeah. Chase Wilsey here, Vice President of Wilsey Asset Management. As always, here to take your calls. You want to join the show, got a question about, a particular company, give us that stock symbol. You got a question about the economy, any other financial topics, really, for that matter. That's what we're here to help with. Phone number, if you want to join, again, 833-288-0973. Again, that's 833-288-0973. But first, we got to cover those topics. And I did want to say, I see you're wearing that Padre polo this morning.
Yes.
We're not a sports talk show, but got to say it. Gosh, go Padres, up 2-1 on the Los Angeles Dodgers. That is huge. Big game tonight. That'd be awesome to see some San Diego pride come through and Joe Musgrove on the mound. So looking forward to that.
Yep, that's why I wore the shirt. Although you didn't wear your Padre shirt today. Oh, underneath the jacket?
No, I didn't wear it underneath either.
Because I thought, I'm going to wear it today. So I've got it. It was given to us from the Padres, so I wanted to wear it. But let's jump into the inflation numbers, because that's something that's really got people worried. And inflation numbers were released yesterday, rising 8.2%. Actually, it was on Thursday, not yesterday. Thursday it was, over the past year. Initially, the markets were down about 2%, but by the end of the day, markets rallied up over 2%. Now, perhaps inflation is not as bad going forward as we think. One reason for that is the lapping of year over year. Now, September 2021, inflation began increasing 5.4%, October 2021, 6.2%, and then November 2021, up 6.8%, and December 2020 inflation increased by 7%.
And what we believe is happening and why we think we'll see inflation slow down is the supply chains. Well, they've improved. Consumers have pulled back on some of their spending, reducing demand. And I got to say, we're still seeing inflation quite heavily in a lot of things like food prices, which I do think should kind of temper here somewhat. But I know that's been quite detrimental. And again, as we mentioned, as we lap that higher inflation numbers from the previous year, that percent growth will not be as high. I mean, as you said, December 2021 is up 7%. I mean, that's quite a large number. That's going to be hard to grow another 8.5% on 7% inflation in December. So I feel quite optimistic again that we'll see it come back down. But again, it's not going to be 2%.
So it's about the slowdown in the growth is what's going to see in that.
Deceleration,
right.
Yeah, so something to keep an eye on. And the problem is right now, I mean, you talk about bank earnings. Those came out yesterday, and JP Morgan, Wells Fargo, I mean, they reported very, very strong numbers. And it almost appears that spooked the market. The market is very interesting right now. And this is why I always tell people, don't try and time this. Because right now it's almost like, oh, the news is good, but, oh, gosh, it's a little too good that the Fed's going to continue raising rates.
Right.
And even when it's maybe bad, it's not bad enough, so that's not enough to send the market higher. Or sometimes you get bad news, and that's good news because...
Well, and that's exactly what I was going to say. I've been doing this for many years. I remember going through 2008 and so forth, and it's just like bad news is good news for a while. Eventually, it does change. But, yeah, it was a shame because the bank earnings came out. They were good. The banks were up. Market was up. And then I think they started saying, oh, but wait, this means that they could raise rates more than expected because they had good earnings and so forth. So that kind of destroyed the markets. But I do want to kind of back up with inflation because that's the big fear and so forth. What I think is happening now is that we are seeing a deceleration in inflation. I think it reached the peak. Was it June? It was like almost 9%, I think.
I believe it was around then, yeah.
We're now, it was what, 8.2. So it's not like, oh, it's great, but it's pulling down a little bit. I'm now seeing a shift that before that's all they were talking about. Now they're saying, oh, but core inflation. It's like the media always wants to find the worst thing to scare people. But what is core inflation? It leaves out energy and food. Well, those are two very important things for people. So if that's not doing bad, maybe you don't feel as good. And food is still going up. I think eggs are up like 35% or some crazy thing like that. But you got to break these numbers down and really look at what is really going on for your inflation, because core inflation, two-fifths of it is from rents. Now, if you own your home, you don't care.
Yeah.
And I asked somebody I talked to yesterday, are they raising your rents? He goes, no, they're not raising my rent. So, and I know some people they are, but it's a calculation. It's not true rents. It's a calculation they come up with to come up with these rising rents that comes up with this number. So I'm saying it's kind of almost like an artificial number on this core inflation.
Yeah, I mean, it is not I've kind of heard the term a personal inflation rate.
Oh, I like that one.
Where it's like, what is your inflation? How is it impacting you? And don't get me wrong. I mean, people are paying more for things, and people notice it. And it is so funny. You talk about that core inflation rate. When you kind of look at the personal inflation rate of people, everyday people, that what they're spending their money on, what are the two things they notice the most?
What's that?
Gas.
Oh.
And food.
Food, yeah.
But you're not going to include that in core inflation. But you ask the average person, it's like, gosh, gas prices, and I go to the grocery store. I mean, that's what's really hitting home. It's not your core inflation rate.
Right.
I mean, that it is kind of ludicrous when you break it down that way. And I think a lot of it stems from that consumer confidence. And if we can get energy prices and food prices back in line, I think the consumer is going to feel much, much better. And we've talked about this a lot as well, as we head into that holiday season. I mean, we talked about Nike a few weeks ago. Gosh, Nike had that glut of inventory. We know that Target has had issues with this. Walmart has had issues with this. This is going to be positive for Christmas shopping for a lot of people, because retailers are trying to get rid of a lot of inventory. Now, you might have to make some sacrifices, and maybe you don't get, let's say, hoodies or something for presents. Maybe you get some summer gear, but you can find some good deals out there. These retailers are trying to clear that inventory.
Yeah, and it's just that we want to say that, yes, and you said it, there is inflation out there. But my thing is, too, is like, okay, eggs are up 35%. I won't buy eggs for a while. I mean, I don't have to have eggs. I love eggs. I buy these things from Costco. I think they're egg bites or something. I love those. But I don't have to have them. So, again, you can make your own personal inflation and say, no, I don't need that. And I've told people, too, the difference in inflation between a 21-year-old in college versus a 70-year-old on Social Security, completely different inflation numbers, because your purchases are far different. So,
yeah. And again, reemphasize it one more time. We're not saying that inflation is not a problem, because it has been a problem.
Yes.
But it's not as bad as the media is making it out to be, in our opinion. And I think you will see this subside as we exit the year. And there are a lot of positives out there that you need to look at to incorporate that into what is going to happen in the future. What's happened in the past, happened in the past.
Yeah.
How do we proceed from here?
Yeah, and people, and I'll talk more about this in my segment tomorrow on KSI, about understanding the value and how things can be affected by the news that comes out. You have to understand that. And again, people thought, oh, the banks are going to do terrible and so forth. Oh, surprise. They did better.
They didn't do as bad.
As bad. And we did talk about this, that the banks do better when interest rates rise. What happened? Oh, they did better because interest rates rose.
Yeah.
So let's talk about the strong dollar, because earnings will be coming out over the next few weeks here. Again, they started yesterday. And the strong dollar, which is up about 17% against weighted index, could play havoc on some companies with big earnings coming out from overseas.
And I was surprised to see that San Diego company, or Qualcomm, gets 96% of its revenue from outside the U.S. That's because they make the chips, they design the chips, and they kind of outsource a lot of their manufacturing overseas. And then they sell to the different companies from around the world. So it is an interesting kind of dynamic, but something that could cost them. And other companies that you need to watch out for would be Caterpillar. Surprised by this, 62% of revenue from the outside the U.S. And even Meta and Netflix both receive 59% of revenue from outside the U.S. That shocks me with Meta. I would not have anticipated that. And another surprise was Citigroup with 52% of revenue from outside the U.S. I didn't see if they reported yesterday. I noticed, Wells Fargo, J.P. Morgan. I noticed First Republic Bank. I noticed them because I actually banked there. I saw they were down like 16%. I don't know if they had issues.
They're a regional bank, aren't they?
I believe they're a regional bank.
Yeah, so I'm wondering if the big banks have a better advantage over a regional bank. Do they do mortgages, First Republic?
I believe they do mortgages and they do real estate, and that might be an issue.
Right, and it could be because I'm seeing I watch the real estate market, the higher end, real estate in general is really cooling off a lot. We saw the mortgage rate hit 6.92%, I think on Friday, I think it was. So that's huge. That you're now bumping up to 7%. That's slowing down purchases dramatically.
And that rate can be, I think, quite deceiving as well. I mean, if you're an average person going to get a loan, I think you're paying in the sevens now. And I mean, gosh, the 10-year Treasury crossed 4% for the first time since 2008.
Yeah,
I mean, it is. We're seeing those higher rates.
Yeah, and that's going to continue a little bit longer. I think we will have our interest rate rise again when they meet. The Federal Reserve meets again, so we will see a definite 7% mortgage rate, and people just like, I don't need to buy, not going to buy, and that's going to be. We always talk about the biggest thing that we always talk about: supply demand. And if you can't have that demand because you can't afford the mortgage, and the supply will increase because then people say, oh my gosh, my house is falling in price, I better sell now. The supply will increase, demand will fall, and prices will drop.
Yeah.
So, and that whole point being, could hurt banks that do a lot on real estate side.
Yeah. And I mean, kind of back to Citigroup, it is interesting. I mean, they've been one that has just had the lowest valuations, and the outside the U.S. revenue as something that's kept us out of Citigroup for years. It's just something that we haven't been comfortable with. I know they had some issues with some overseas lending as well, and it's, I would like to buy it. They do the Costco card, and they have my other favorite double cash credit card, but there are some potential pitfalls with it. And I mean, who knows? Maybe it could be a great opportunity right now if they can resolve a lot of those overseas issues. And they honestly could be the big winner in banks over the next 5 years because their valuations, I believe they still trade under book value.
And yeah, because we looked at Citigroup, the numbers look good on it, but just didn't feel comfortable with it. And one thing that's going to happen as well is that the dollar's not going to stay strong forever.
Exactly.
Eventually something's going to change, and then the opposite will happen. So then it may make sense to buy a Citigroup or a Qualcomm. You want to really read those reports when they come out, we'll say in the next few weeks on these companies to see what they're saying about their personal situation on the dollar strength. But I was reading too this past week that they don't expect the dollar to drop anytime soon because we do have a good economy, quote unquote, compared to, I'll say, the rest of the world, rising interest rates, so that will keep the dollar strong. But maybe in a year or so, it could reverse around. That may be the time to jump into a Qualcomm or jump into a Citigroup or something of that nature. And I kind of hope that somebody calls on some of these companies so we can kind of look at them in more detail. But, and these are things people I probably don't think about. Thinking, it's going to be great because of the chips and so forth. But you got to understand that with a strong dollar, your profits will be lower. So,
and I am seeing here with Citigroup, it looks like they were pretty much flat yesterday, and they did report.
They did report. Okay.
They did actually beat on earnings, and looks like they beat on sales as well. So, another bank that did quite well.
Yeah. Well,
it doesn't look like they beat by as much as like Wells Fargo and J.P. Morgan, but still a positive for Citigroup, and I think. While I sit here and say, it's something that's kept us out of the overseas revenue, it is something that I would say could be an opportunity. And, I definitely think Citigroup's worth a further look, based especially on those valuations.
Okay. Let me get the phone numbers out again because we'll be opening the lines pretty soon here. 833-288-0973. That's 833-288-0973. 0973, and you got a company or investment in equity that you want to talk about, give us a call. We'll give you that unbiased, no strings attached, fundamental opinion on what you want to talk about. We haven't talked about crypto in a while, so let's kind of bring up crypto. With the decline in the crypto market, investors are becoming less comfortable with this space. According to a recent bank rate survey in 2021, nearly 35% of Americans said they had some level of comfort investing in digital currencies, compared to about 21% in 2022.
And millennials saw an even larger fall, with 49% in 2021 saying they had some comfort level investing in digital currencies, and that fell to almost 29% in 2022. That's a huge decline. My guess of why this is the case is digital currencies have yet to show a meaningful use. It has not proven to be a viable currency for transactions. It has not proven to be an inflation hedge, nor has it proven to be a hedge against declining stock prices. I still just don't see the allure of investing in the space. What's the utility of it? Digital gold. What does that mean? And I haven't even heard really much about it lately either.
Yeah, about crypto, you mean?
Yeah, about what is the excitement? What is it solving? And
you still hear a little bit about it. They'll still kind of quote it on Fox Business, the price, and it seems to go from, I'll say, 18 to maybe 20, 21,000. But the big excitement was before it was going to 20,000, 25,000, 30,000, 60,000. Like, oh, this is great. It's going to go to 100,000. Well, that's now gone. So that was a big thing it had, is that you can make money off it because it just went up for no reason. Well, now, and I think it's been well over 6 months, it's been in this range of 18 to, we'll call it $21,000. And you're right, there's no utility. There's nothing, it's not an inflation hedge, which, by the way, gold has been a terrible inflation hedge as well. So that didn't work for it. So, and again, we have said before, there will be digital currencies, but I just don't think it's going to be these private currencies as much as people want them, because I've talked about this before. The world does not want to have a global currency. They want to control, countries want to control their own currency so they can control their economy. Can you imagine what we would go through now or 2008 if we can control our currency? We couldn't raise rates because we didn't control our currency. It'd be a terrible situation.
Or do you really think China wants a global currency unless it's their own? No, I don't think so.
Yeah, no country, unless they're a weaker country. I forget who it was that tried it.
It was not Venezuela. I think it was El Salvador.
I think it was El Salvador, because they're a weaker country. But your stronger countries, your big countries, China, Japan, U.S., England, Europe, they're not going to want a global currency. They want to control their own currencies. And that's why this whole thing, you don't get it, it's going to be the world. And it's not, because the world will not let that happen.
Yeah, and I just, again, got to say, I don't get the space. People that say they get the space don't. Clearly, 49% thought they understood it for millennials, and now it's only 29%. So I think people realize, like, I don't really understand actually what it is. And I do wonder, I mean, we talked about this probably a couple of years ago, but how Bitcoin in particular, a lot of people lost access to their digital wallets. I want to say the number was almost as high as like 20% of all Bitcoin was like lost.
I think you're
so
close
that
number.
Means that Bitcoin can never be traded,
right?
Unless somehow it gets found, which I don't know how it would get found. So that means that's supply that has been taken off the market that almost kind of keeps the price a little more artificially elevated, because it reduces the amount of potential currency that can get traded onto the market. Yeah. And then you have your people that are Bitcoin forever holders, those, they call them the diamond hands. They're not going to sell it. So I'm very curious what the trading volume on Bitcoin and other cryptos looks like now, if it's almost like kind of artificial, where because you have such a small subset of the population that's like, nope, I'm not selling, that there's not much activity, that there's kind of a floor that's being created. But all of a sudden what could happen is now there's that, I'm just using numbers here, 80% of people are like, well, I'm never selling my Bitcoin if it goes below 15,000. Well, now that only means there's only 20% of the market, let's say, that's trading, and it's going to be based off those 20%. And those people might be saying, I'm done with this. I thought this was going to go from 18 to 30,000. That's the only reason I bought it. They start selling out. It causes this chaos in the market. And you could see it fall from 18,000 to 10,000 very quickly. And
also, too, people, their investment starts going down. They don't have the money coming in. Oh, I need a new car. Oh, that Bitcoin's not doing anything. I'll just sell it now and get out of it. And so that will happen. Time will wear that down. All right, phone number is 833-288-0973. That's 833-288-0973. Jason, we've not got an email request in a long time. I guess because we don't announce it. But if you don't want to come on air and you want to ask us a question, you can do it by email. Just go to our website, smartinvesting2000.com. That's smartinvesting2000.com. And just send myself or Chase an email with your question. So we've got one here. That's why I brought this up. Says, hello, Brent. Long-time listener to your radio show. Really enjoy listening to the two of you. I am not one to call into the show, but if you have some time tomorrow, I'd love to hear your thoughts on WPC. It seems to be good to be true. let's see, it seems too good to be true with a 6% dividend. I know estate, I think it means real estate, is going to get worse, but would like to hear your thoughts on the stocks. And that's Dave from Tennessee. So let's take a look at WPC, and it's obviously a REIT, a real estate investment trust. Their symbol is WPC. The company is WP Carey is who it is. Now, looking at this company, we see there is a little bit of float on it on the short side, 4.1%, but that's not a worry. 64% institutional owned. They do have a high PE ratio, and I think you're going to cover the FFO, but we'll just talk about the PE ratio, 24.9 versus 10.3. Price of sales also high, 9.4 versus 6.6. Price to book value 4 versus 1.4, and price to cash flow 13.4 versus 12.5. So the valuation ratios are very high on this company compared to the industry, so that makes me a little uncomfortable. I do not see a PEG ratio on this, which is your price earnings divided by growth. It is 28 for the industry, nothing for WP Carey. Now, their earnings have grown by 11.3% over the past year. That's better than the industry growth at 10.2%. Sales climbed by 10.2%, not as good as the industry at 16.1. Now, I don't see a 5-year earnings per share growth estimate from the analysts. I'm wondering if there's any analysts that follow this, which could be a problem here. I do see the 6.2% dividend yield. That is higher than the industry at 5%. They use 152% of their payout ratio to do that, which is more than the industry at 100.9. So there could be a problem with that dividend. Looking at the balance sheet, oh, this is terrible. Current ratio 0.2 versus 7.0. That shows me this company could have a liquidity problem very soon, because you want the one compared to that, because you want your assets and liabilities at least be equal. This means that, just a ballpark figure here, your current assets are about 80% less than your current liabilities. If that's a quick formula I came up with that I think makes sense. It's not a good seeing that point ratio or 0.2 ratio for the current ratio. Debt to equity 0.9, not too bad. That compares the industry at 0.7. We do see a net profit margin 37.5. The industry is at 67.2, which sounds extremely high. And return on equity is 6.8 versus 8.6, and return on capital is about 4.9. So I'm not feeling good with this. I don't know if you have anything to change that, Chase, but you got some. Your eyebrows are kind of wrinkled there. Now that you got married on Saturday, you're going to get all these worries and everything. Yeah.
It is something that's interesting. Kind of looking at it, I was just thinking about the current ratio. I mean, it's hard to kind of explain that away. I have seen in the past. We have one REIT in particular where the current ratio, the way they accounted for assets on the balance sheet, was a little bit strange. So I'm not saying it's an end-all, be-all for it, but it is very unlikely that I would feel comfortable with the current ratio is something I would say.
And again, we always talk about these numbers, and that's why we do this in like about a 3-minute time frame. We're trying to point people in the right direction. I mean, if we're going to look at this company, it would take 10, 15, 20 hours to really understand that. So that's what we're saying. There's a problem there. You probably want to go check that, because it may not be a problem, but we're saying it could be a problem.
Yeah, and especially with the dividend yield, 6% sounds great, but I know there's some actually other REITs out there as well that are paying higher yields.
Yeah.
So, I mean, I wouldn't be too excited about the yield. I mean, I think with the decline in stock prices, you could find some very, very nice yields at the current time. But I did look at what they did as well, and they do actually have most of the revenue come from the United States, and it comes from single-tenant office, industrial, warehouse, and retail facilities located around the world. And I said predominantly here in the U.S., it appears most of that's the revenue where it comes from. I would be, excuse me, I almost choked on my own spit there. That would have been bad. But you look at the single-tenant office space, I would always want to know who is leasing the space, because sometimes you could have single-tenant, but it could be like Target is 40% of revenue. So you want to make sure that there's not a single tenant that occupies a large amount, because they could be like, we're going to change our real estate strategy and actually buy all our own real estate rather than lease it from you. So something to keep a close eye on. But looking at the current price for WP Carey, again, ticker symbol WPC, it's $68.46. 52-week high is $89.63, and the 52-week low, well, that's $67.76. If we go out to December 2023, I know you're a little worried about the analysts. There are 9 analysts that provide an FFO estimate, again, funds from operation. That is $5.21. Gives us a target sell price at $86.49, about 26% away from the current price. So that would be placed in our hold category. I think there are other REITs out there that I'm more excited about than this one.
Right.
Is, I guess, the best way I'd phrase it.
And you mentioned that they do offices and retail, which right now are two that are having some difficulties. And also, too, I don't know if you mentioned, but where are they based? I mean, regional could be in a great region, could be in a bad region. Yeah. So when you want to kind of look at that, you want to say, well, where are they? Because you don't want them all focused in a bad areas, which you don't want. And
I will say, though, I would want to understand the breakdown because, I mean, they also have industrial and warehouse,
right,
which I think are quite positive spaces right now.
Yeah, because warehouses, I believe, are really packed.
Yeah.
Which is a good thing for the warehouses, but it's because the retailers can't get rid of the stuff. And that's what I'm saying. There's going to be some great sales because retailers want to clear out that inventory to get ready for the Christmas inventory and then the spring inventory. They got to keep that inventory moving. So I think they'll get that rid of it. And it will also show up in discount stores a lot, like the dollar stores, because if the retailers can't get rid of it, they'll just sell it to them for like pennies on the dollar. That's how the dollar stores make their money, is by getting cheap inventory. So... But and again, I think you bring the point up too, is that there are other higher yielding REITs out there. Keep in mind that REITs are interest rate sensitive, so as rates go up, many times REITs go down. And again, you have to understand, does that really affect their borrowing costs? Because if they're not borrowing, they're in that group that their stock will go down, but in reality they're not hurt by it. But if they have like a lot of short term, capital, or they need a lot of short-term loans, they got to refinance those at a higher price. If they're trying to do deals, that they're leverage those deals, it's going to hurt them. So again, it comes back to really understand them. We have two REITs in our portfolio. Both, one's a hold, one is a buy that has just been beaten up tremendously, which we love. But it's just you got to understand the REIT as everything else there.
Yep.
So, all right, phone numbers. Wow, no calls came in. Okay, 833-288-0973. That's 833-288-0973. And if you call right now, you'll get right on through because there's nobody there holding. Well, let's talk about cars, because the problems are starting already with the forced demand of electric vehicles. Lithium, which is used to make the batteries, have tripled in price this year, and there's no end in sight for supply meeting demand. Lithium is not used just for electric vehicles, but also for grid energy storage.
And you may be thinking, no problem, just produce more lithium, which is nice in theory, but not reality. To bring new production online, studies must be done, permitting, capital must be raised before any lithium is produced, which can take 3 to 5 years. I hate to say it, but it's always a disaster when the government forces demand on any type of product. What it does is increase prices that the consumer ends up paying for, and it's funny that the government increases demand for the product but doesn't increase the capability for supply, as the regulations are so stringent. So they don't really have a positive correlation there with supply and demand.
Right. And that's why you have to let market forces do their thing, because when you try to force things, you put the markets out of balance. And I think this could be a major problem down the road, because I've seen lithium prices, they say, could go up 10 times. Well, that's going to put the cost of your EVs extremely high, which means who can now afford them? Is the government then going to say, well, now we'll raise our credits for it? Well, that's not right, because you got a debt situation on your side. So let the market forces take over. And we've talked too about how it's not going to be the fix all for the world. I mean, you've got China just pumping out tons of pollution, India and so forth. So here we're in the U.S., we got to go green. We're not going to change. I think the number's like 0.0001%. We would change the world if everybody went, EVs here. And there's other things that, produce air pollution as well.
Well, the issue as well is you talk about, it's funny how everything works together, but how lithium's used in energy storage is we need energy to do the electric vehicle. So it's not just the EV car that would go up in price. Now you're costing more to get the energy storage as well.
Yeah.
There's a lot of potential cost, because people right now love EVs. No, I'm not paying anything for gas, which is great when gas prices are high. Well, what happens if now all of a sudden EV cars go up in price because you can't produce them? So now you wipe out those savings. Your break even, let's say, on not spending on gas goes from a couple years to now 10 years. Well, is that really worth it? And these are just numbers. I haven't done a calculation on a break even, but just kind of trying to illustrate a point of if the cost of those cars go up, your break even is going to be much further out. If all of a sudden people are consuming more electricity, the cost of electricity is going to go up. That's going to hurt your break even point. There could be some very serious potential pitfalls with EVs if we rush into them.
Yeah. So you got to be careful of that. And this, by 2035, you can't sell any more gas-powered cars in California. I don't think that's going to play out. I think it's going to be reversed. I think it was just a thing that the governor did. Oh, I'm going to do this and so forth. By the time it rolls around, I don't think it's going to happen. All right, well, let's go to the phones. Let's go up to Oceanside and speak with Joe. Joe, you're on the Smart Invest Show, Brent Chase. How can we help you?
How you doing, guys?
Good. How you doing?
Good. I couldn't leave you without a phone call there, So.
Oh, I appreciate that. Now we got like 5 or 6.
I know. Sometimes they just come in waves.
Great. Hey, obviously, my thing was PRU, but, because I was going to, I have some Twitter, and I was going to sell that and, buy what PRU when it was down lower. But I was thinking, because, it looks like that sale's going to go through, so probably everybody will get the 54.20, I'm guessing. What do you think on that?
So you're looking at so you sold Twitter already. So you're thinking about buying Prudential?
No, I still own it.
Okay, but you're thinking about buying Prudential.
Or he's looking at should he sell Twitter now or wait till 54.20?
Oh, wait, you both talked to me.
Yeah, because I figure he's going to have to do that deal. I'm guessing that's
right
now. So.
Right. Yeah, he seems to be locked into that deal.
Yeah. So he's asking should he sell Twitter now and buy Prudential or wait until the 54.20? Is that the correct question?
Yeah, I would rather buy Prudential when it was down 88, 89. When I had that chance, but that's the question.
And what did Twitter close at on Friday?
50.45.
Yeah, so you're short about, we'll call it maybe about 9% or so. Things can change on that. If you get a profit on Twitter, I would probably take it because to wait for that extra 9%, I mean, who knows what's going to come up on that. I would not count out Elon Musk yet. And he could also say, you know what, screw this. I got $1 billion. Here's your $1 billion. I'm walking away. That would, I think, cause the price of Twitter to fall dramatically.
Yeah. Now, I think it's a dangerous game. I mean, a lot of times we look for arbitrage opportunities where the deal price is higher than the current price, which is still the case with Twitter. But I always like to find a company that I wouldn't mind holding if the deal fell through. And I tell you right now, I would not want to hold Twitter if the deal fell through. I think Twitter is not worth 54.20. So
right.
Yeah, but Prudential went up pretty good, last couple of days, and so it's not really as attractive anymore.
I'm kind of curious on Prudential if you should even be buying it. So I do want to go over the numbers with you here as well, but because it is a space that I think would do well. But let me take a look at it because I'm kind of talking here. I want to see some numbers myself here. So company is Prudential. They're in the life insurance industry, only 2.3% float. Institutional ownership, 60%. I'm surprised here you're paying 17.2 for an insurance company, well above the industry at 8.3. Price of sales, 0.6 is good. Price to book value, 1.3 versus 4.1. That's a big positive. And then price of cash flow, 3.5. That's above the industry at 2. So not thrilled on that. Now their earnings are down year over year, 70%. Industry down 51.6. Their sales down 8.8, industry down 15.9. I know insurance companies had a hard time. We talked about this probably 6 months ago. They had a hard time because of lower rates. They couldn't really be profitable. Now rates are turning around, so that could be a big benefit to a Prudential. They do pay a very nice dividend, 5.1%, use 84% of their earnings to pay that out. Their debt to equity, 0.7 versus 0.5. Net profit margin for Prudential is low, 3.3 versus 8.2. I'd probably want to know why that is. And the return on equity is low at 7.4 versus 10.4. So I'm really kind of curious what you see going forward on the earnings there, Chase.
Yeah, so current price for the company, again, Prudential, PRU, $94.67. 52-week high, $124.22. 52-week low, $85.46. Year-to-date is down about 9.5%, which is, well, better than half the industry excuse me, not the industry, the S&P, which is down 24%. So it's held up better than many other stocks in this environment. But going forward for the company, I go to December 2023. I mean, it looks very strong. Estimated earnings per share of $11.63 would give us a target sell price of $193.06. So it has a forward PE multiple around 8. So, I mean, it's a very good value at this point. I will say it is interesting to see the year-over-year growth for December 2022, so the end of this year, is earnings are looking to fall about 35%. What I think is happening is, a large part of it at least, is the bonds on the balance sheet. While you're right, now that the rates are going up, it'll help with the income on their portfolio. They're having to write down the value of those bonds, which could be hitting the earnings. But I'm it's so funny. We've talked for years about how, gosh, bonds are terrible, stay away from bonds. I'm not quite there yet, but we talked about the 10-year note being around 4%. I personally don't believe the 10-year note is going to go to 8% or anything crazy like that. So I think you could start to see insurance companies not have to worry about bonds. They might be in a kind of Goldilocks type situation where now they can actually pick up yield on bonds and they don't have to worry as much about rising interest rates impacting the bond portfolio.
And Joan, I think it has to do with what they do, because if they do a lot of annuity sales, people start cashing those annuities because, gosh, I'm going to get a 2% yield. I can go over here get a 4% yield. They're going to start cashing those annuities, costing the insurance company to actually sell those bonds at a low price. I do see, like 90 days ago, they were looking for earnings at $12.64, so that could be happening with them. But I think Prudential is more on the life insurance side. And insurance companies are generally good long-term holds. Short-term, it may go lower, but I've held an insurance company portfolio now for, I think, like 14, maybe 15 years. It's done extremely well for us, but you have these periods that go through. So short-term, I'd probably say no. Long-term, you may be watching this company as a good buy.
Yeah.
All righty?
No, it's definitely a longer-term play. But thanks a lot, guys. It's always great to talk to you again.
You too, Joe. Thanks for calling. Have a good one.
Yeah. Bye.
Bye-bye. All right, that does open the phone line, 833-288-0973. Again, that's 833-288-0973. Anthony in San Diego, hold on. We're going to go to you right after we talk to our financial planner, Harrison Johnson. Good morning, Harrison. How are you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Well, good. We got some big news today you want to talk about on Social Security and Medicare. Good news, big news.
So with all the bad news in the media, we've got war and gas prices, inflation, recession, all these things. It's nice to get some good news sometimes.
Yes.
So two things. First of all, Social Security is going to get one of the largest increases that it's got in 40 years. It's going to get an 8.7% cost of living adjustment starting in 2023. They just announced that this week. Last year, it got a 5.9% increase. It was still not bad, and the year before that was 1.3 and then 1.6 before that. So we've had quite a few years of really small increases, so it's nice to get a big jump. Now, this is a result of higher inflation, so the other side of that is inflation must be pretty bad for us to get an increase like this, but it is what it is. So if you have a monthly benefit amount of $2,500 a month, this 8.7% increase would be about $218 a month, so that'd bring you up to $2,718 total. So excited about that on the Social Security side. And then secondly, the second thing is Medicare Part B premiums are going to be decreasing for the first time in over a decade. So with Medicare, you have Part A and B, that's called Original Medicare, and everyone has that. From there, you pick up an Advantage plan, otherwise called Part C, or you get a supplement plan, which is called Medigap. But everyone has the A and B. Part A has no premium, but Part B does have a premium, and that gets deducted directly from your Social Security check. So this year in 2022, the premium for Part B starts at $170.10, and next year, starting in 2023, it's going down to $164.90. So it's not that much of a decrease, but just the fact that it's decreasing, is nice to see. So the Medicare premiums are not based on inflation, obviously, because they're going down. What happened was the decrease came because Medicare overestimated their Part B services last year, which led to a larger reserve, and now they're passing some of that back, which should make sense because last year it went from 148 up to 170, which was the largest increase in history. So this is nice that now we're going to see a little bit of reduction on that Part B premium. So overall, starting in 2023, our net Social Security checks are going to look a little bit larger with increased benefits and decreased premium payments being deducted from that.
Yes, and that's all good news. There is bad news with the good news, though, because now they're going to be spending out more, the 6% increase? Is that what the increase was?
8.7.
8.7.
Yeah.
What that's going to do is get us to that date where Social Security will not be, it's not going to be eliminated, but the date where it's going to be cut to where now you and I think I've said it's going to be cut about 28%. So if you're getting $1,000, and I think there's like now 2,034, I think it is, this could get us closer to that date because now those estimates of how long it would last were based on past payments. Well, now being increasing by 8.6%. Well, now you're going to get to that deadline quicker. Will actually cut Social Security by about 22%, I believe is the estimate.
Yeah, that's true. It's constantly changing depending on how payroll contributions are going into it versus what the benefit amounts are going out. But it's in the early 2030s that it's expected to happen. So between now and then, something needs to happen, a combination of tax changes or benefit changes, because if that doesn't happen, then you're right. We will be the trust fund, so to speak, will be eliminated or will run out. So the only amount left to pay out benefits are what people are currently paying into it through payroll contributions. And right now, it's about 80% of what benefits are. Now, I think before that happens, hopefully, Congress decides to do something, but, it's politically unpopular to talk about changing Social Security in any capacity. So, we get an increase for now, but it makes the overall problem a little bit larger, and that is something that needs to be dealt with.
It was funny as well as I know the White House was celebrating the increase in payments and the decrease in Medicare. They took some flack for that because who gets hurt the most by inflation is retirees.
Yep.
Because even though Social Security is going up, many times they're on a fixed income with a pension, or even if you're living off your assets, most of the time you're not going to give yourself a pay raise if your investments are going down in a period like this. So inflation really hits retirees quite hard because they're not benefiting from wage inflation whatsoever any longer, which, that's kind of help offsetting some of the inflation for the working class. But, it is something to kind of keep an eye on. And I think a lot of retirees will be okay. You can't panic in times like this, and you'll get through it. But you could really cost yourself your retirement if you do the wrong things in this situation.
Yeah, no, I've said for many, many years, Social Security was never meant to be your sole retirement fund. It's a supplement to help you out, but there's a lot of people that it really makes a big difference on can they make it to the end of the month for rent and food and everything else. So, but to celebrate that, no, all you're trying to do is keep pace with inflation. It's not like, oh, you're getting a big raise. No, you're keeping pace with inflation. So, but we'll stay with the good news that we're glad to help people out. Well, not us, but then we're glad that they can raise to keep pace with inflation. But well, Harrison, thank you very much, and you have a great weekend. We'll see you on Monday.
All right, thanks, guys. We'll see you Monday.
Okay, bye-bye. Again, that's our financial planner, our CFP, Harrison Johnson. If you want to talk to him, he is on a salary. He does not charge commissions. He's a fee-based financial planner. You can give him a call at the office at 858-546-4306. That's 858-546-4306. Or go to the website. You can send them an email, smartinvesting2000.com. That's smartinvesting2000.com. All right, let's go back to our calls here. 833-288-0973. Again, that's 833-288-0973. Let's go out to San Diego and speak with Anthony. Anthony, you're on the Smart Invest Show. Brent Chase, how can we help you?
Hey, good morning, guys. Thanks for taking my call.
Sure, thanks for being there.
So semiconductor stock prices just continue to drop. Just wanted to know what is your guys' take on what's going on with that sector. The stock prices look good, specifically AMD. Do you think it's a good time to start looking at that sector and accumulating some of those stocks?
In summary, yes. And I know it seems like just 6 months ago, like, oh my gosh, everything was on fire with chips and so forth, and we knew the demand would be there. Now it's fallen off the cliff here. So this is a time you want to be investing in good businesses that will do well long term. And I think we're now having a fire sale. Will the fire sale get more? You don't know, but you will look at to see, is it a good price here? So we'll take a look at the numbers here in a minute.
And I always say that a lot of the negativity revolves around PC demand. Oh, PC demand's falling. And one thing that we were talking about kind of before all this chaos in the chip market was how chips are being used in more and more things. So while, yes, PCs are slowing down, we'll go through another wave where PC demand will pick back up. But the other thing is I think a lot of these companies are going to be able to diversify their end consumer somewhat and kind of not be as reliant on the PC market. Now, that's my estimation. There might be some chip makers that are able to diversify much better. But I think overall the amount of chips being used across the world in a bunch of different products, I think is going to be beneficial for the chip making industry.
And I don't have the numbers with me, but I remember reading something that they said that the average PC is still rather old. It's not like, because of the upgrade during COVID. The average PC, I think, is still, I want to say, like 3 to 4 years old, which is quite old for technology.
I know. I still have it's a MacBook, but mine's from like 2015, and it's still running well, so I haven't gotten rid of it.
And the Macs will last a little bit longer than your regular PCs, but I think the PCs, generally you want to replace those every 2 to 4 years maybe. So, but let's look at the numbers on AMD, because I think this could be one that could benefit going down the road here. Their symbol is AMD, which stands for Advanced Micro Devices. Only 1.9% float on the short side, 68% institutional owned. PE ratio is rather high. It's 23.8, well above the industry at 13.9. So I'm disappointed with that. Price to sales 3.6 versus 3.4. Price to book value 20.9 versus the industry well over 500, so that's a positive there. Price to cash flow 20.8 versus 9.7, and the PEG ratio very good, 0.7 versus 4. Now we do see the earnings for AMD were down 27.7%. The industry was up 43.3, so there could be either some write-ups going on there or some problems with AMD you want to know about before you invest in the company. However, sales did climb by 45% for the past year. The industry is only up 9.8. That's a big positive there. 5-year estimated growth on the earnings is very good, 25.5 for AMD versus 14 for the industry. They do not pay a dividend. We do see on the balance sheet, current ratio 2.4 versus 2.7. That's good. Wow, debt to equity for AMD only 0.1 versus 0.6, so almost no debt on the balance sheet at all. The net profit margin 14.5 versus 25%. I'm almost kind of thinking they had some write-offs with that decline in earnings and the low profit margin. But again, do the research to verify that. We also do see that they have a return on equity of 5.7 versus 27.7. Return on investment capital 5.5 versus 20.8. So there is something around there. You got to check that before you invest in the company. Chase, what does it look like going forward?
Yeah, current price here for AMD, $55.94. Wow, 52-week high, $164.46. 52-week low, $54.57. Year-to-date, the stock is down 61.1%. If I go forward for the business, go out to December 2023, I see estimated earnings per share of $4.09. That would give us a target sell price of $67.89, which is unfortunately just a gain, I think around 20-ish%, somewhere close to that range. We like, again, a 30% margin of safety. So it wouldn't be in the buy category just yet for us. I will say their growth does look pretty good on the earnings per share, which gives me a little more optimism in it. But again, we stick to that 30% margin of safety. The other thing I will say about AMD is I believe they purchased that company, Xilinx, I think was the name of it.
Yeah.
I believe they drastically overpaid for that company. Could be something that comes back with a write-off. And I don't know if maybe that's why their earnings took a hit here lately, but that's something that I would want to understand a little more detail, is some potential pitfalls with that.
Yeah, you get the goodwill write-offs, and it could be a big numbers that will hurt them. I do see the earnings have fallen over the last 9 days from like 493, so they are falling. But I like the idea here, Anthony, because I think it's a good industry to look at. I just don't know if AMD is the chip company I want to invest in right now.
Yeah, and I think AMD and NVIDIA in particular, they ran too far, too fast.
Yeah.
They became way, way too expensive. I think part of it is, I'm going to say somewhat justified. They were having very strong businesses, but I think they just got too expensive. They're coming back down to reality. I think you could see some growth in the stock price because of the industry doing well, but I don't think you're going to see the big boom that you saw with those two companies, and it could be like the tech boom and bust where it takes a long time to get back to where you were at. I think there are other great opportunities. I mean, I think Lamb Research, the Applied Materials, I think those are interesting ones to keep an eye on as well. But this one's still just not quite where I want it to be.
Yep. So I'd say keep searching there, Anthony. All righty? Anthony? Did we lose him? I guess we lost him. All right. Well, I'm sure he's still listening. All right. I know we had, I think it was Robert, want to talk about Tesla, but I think, is he gone there? I don't see. Okay, so he left. And I want to talk about that because, I mean, Tesla has dropped dramatically. And actually, I think the EV market's having problems. I saw Rivian had problems. But the other thing, too, is that I think with Tesla, it's starting to come away. What if he does have to take on Twitter? How's he going to manage Twitter, Tesla, the Boring Company, SpaceX? I mean, he's a Superman. We'll call him that. But there's only so many limits that he can do. Will Tesla be the one that gets hurt the most? Because I have seen the stock drop dramatically. Gosh, it closed on Friday, $204.99.
I will say, I mean, I think he does push that 24 hours to be very, very efficient. I think the guy's a genius. I mean, I've never had a problem with how smart he was. I just always have had an issue with Tesla's valuations. But the thing is, there's still only 24 hours. Even if he could work 24 hours in a day, we know that's not possible.
Right.
I mean, that's a tall order. That's 4 companies now.
Yeah.
And not to mention, he wants to fix Twitter. You're not now just running Twitter. You're fixing Twitter, which is going to take a lot of time. Right.
And actually, I saw a YouTube video on him probably like 2 months ago. I watched it about his schedule. He is very organized. He is very like a machine. But you're right. There's only 24 hours in a day, and you bring on this another thing to do. Something has to give. Will it be Tesla? Will it be SpaceX? What will it be? Will he not put as much into Twitter, which that will then fall?
I still think he has like 10 kids or something as well.
Yeah, he's got and he does spend time with them to some degree. Yeah. I mean, he watches no TV. Yeah. He has no time to watch TV. But he has like these schedules that he does, and he does schedule time with the kids, but he does, have it set up to where he has certain businesses he'll work on. But you're right, the sickness of Twitter, we'll call it, is going to take a lot more time, which he has to give away time on something else to do more in Twitter. And I did notice that Tesla did reach a high in the past year, $414, almost down 50% from there at 204. I think it was even higher than that a little bit before that time frame. I think it was
it's confusing because they split so many times.
Yeah, but I think split adjusted. I think it was because I looked at it before. I thought it was either 430 or 440 because I know it's getting close to being down 50% from their all-time high. You looking at it right now? Let's see if
and 50. Yeah, it's down 50% because that would be 408. So it is down. More than 50%.
More than 50%. Yeah. So, it just shows year-to-date return a negative 41.8. Their market cap now down to $642 billion. I think they're still bigger than the car companies, but it is a great car. But we've talked about this for a long time that it's just way overpriced and nothing stays in that lofty level forever. There, something will hit and come down. So I just want to look at the earnings going forward.
I was going to say, it's kind of funny, we're reversing roles here a little bit, but I was looking at a balance sheet. It is funny. For years, I say funny, but for years we thought they were at risk of going bankrupt, and they were. But their balance sheet is very, very clean now. The current ratio is 1.4, quick ratio is 1.1, so they have plenty of liquidity. Debt to equity is just 0.2. So they've really done a great job fixing that balance sheet. And I think part of it was they were able to capitalize on how crazy their stock price was. I mean, any other company, you issue stock, the stock price goes down. With them, they would issue stock price goes up. And they were able to generate capital that way. And also, too, they did a lot of convertible bonds, which they were able to offer at lower interest rates.
Right.
So, I mean, they were able to I don't want to say take advantage of shareholders, but they were able to take advantage of the craziness in the stock price.
Yep.
And that's the reason they were able to avoid, I think, bankruptcy at the end of the day.
Yeah, because normally when a company, you're right, would issue more stock, it would fall, they wouldn't get what they wanted and so forth. But the followers of Twitter were so strong,
Tesla.
like, oh, yes,
Yeah.
I'm sorry, Tesla, were so strong that, oh, yeah, and it would actually bid the price up. So, and they were smart not to just kind of take it, but to like, okay, let's pay down debt, let's do these things. So I did look at their earnings going forward. For 2022, looking for earnings of $4.10. 2023, $5.87. So they're making more money, but that still gives you P ratio, forward PE of what? Still 40, I think, in my
About
head.
35.
35, yeah. So
35, 40 in that range.
yeah, much better than what it was like at 70, 80, 100 plus, but still not the norm. The norm for the industry historically is around 14 to 17 times in a PE ratio. So they're still well above that. So
Well,
it
that's
could
for
be.
the market. The auto manufacturing industry,
Oh,
which
you're
is
right.
what they do,
Right.
is more like
Yeah.
7 to 8.
7 to 8 is
and that's just kind of based off of understanding of, a couple of the auto manufacturers we've held. But it's not the market average, unfortunately. But yeah, Tesla's trading well above the market average and the industry average, which has always been the issue I have. It's not a car company. Well, then what is General Motors? General Motors now has a defense unit. They have a Bright Drop, which is a business unit. They're also building an energy unit like Tesla.
Yeah.
So I'd say they're kind of competing on similar playing fields, especially setting themselves up for the next few years. But one's trading at 6 times earnings and one's trading at 35 times earnings.
And one thing I just noticed in this, I've never seen this. Well, maybe I have. This type of drop off in earnings. 90 days ago, they were estimating $15.89 in December 2023. As I said, now it's $5.87. That's a 63% drop in your estimated earnings going forward. I mean, that's huge. You just don't see that. Normally, a stock would, well, again, they are down from the 414 or whatever it was. So the question is, will it fall more? I think it could.
Yeah.
EV market's having problems, we said, and if Twitter does go through, or he pays that, he pays that $1 billion. I don't think it's really going to hurt him or Tesla. That may be the better thing to do, is just pay that $1 billion and walk away from this, because, and I would love to see him turn around Twitter, but I think it would sacrifice too much on the other side.
Yeah, I think it could be very problematic.
Yeah. So, but Robert, I hope that's what you were kind of looking for. Did you get a target sell price on what Twitter would actually, or Tesla would actually be at 587?
No, I just had the forward PE, but let me do that real fast.
Probably going to be about 75 to 80 is my guess.
97.
97. Okay. Yep. So that means it could be cut in half again. Before it became a sell on a reasonable side. So, but yeah, I mean, that's where you look at things. And I will say here, I do see the average sell price, and this is interesting as well for the 25 analysts. They say 308, but I just don't see that happening with Tesla.
Yeah, it's just still expensive. I mean, it's by no means a value company. The growth is decelerating, which people don't like to see. So it could be a problem.
I was thinking too, when you talk about Tesla buying or selling their stock went up in price, wasn't one of the meme stocks, was it AMC did that, or was it GameStop they did that? And now it's been cut way down in price.
Yeah, I think AMC was one, and they offered it was called the ape shares as well. It's somewhat deceptive in terms of the stock price on AMC of what your true investment is, because you did get a new share class.
Right.
But even with that ape spinoff, you're still down dramatically. Yeah,
we talked about the meme stocks. They kind of went to the junkyard. I'll call it that way. Yeah, they haven't done well. I've not looked at GameStop in a long time. I think AMC. I think I saw them down. I was going to do a post on it. I don't think I got time to do it, but I think they're down 70, 80% from their high. And I feel bad because all these people got stuck into it.
And here we are.
Here we are again. They lost. Well, there's a closing bell. Thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. 546-4306. And please visit our website, smartinvesting2000.com. That's smartinvesting2000.com. A lot of great information there. And for more daily educational information on investment tips, go to our Facebook page, Smart Investing with Brent Chase Wilsey. Thanks for listening. We'll be back next week right here on the Smart Investing Show.
To think that I did all that